Good day, everyone. I'm Jacques Conradie. I'm the CEO and one of the portfolio managers at Peregrine Capital, South Africa's longest-running hedge fund business. Our presentation today is entitled Uncorrelated Alpha. What does that mean? It means outperformance without taking increased level of market or stock-specific risk. What does it practically mean for investors? It means that if you add uncorrelated alpha or a fund like ours to a client portfolio, it will both increase their expected return of that portfolio while at the same time reducing the overall level of portfolio risk. This is effectively the holy grail of investing, the best of both worlds. In our presentation today, I'm going to spend some time on what makes a hedge fund different from a long-only fund, but spend most of it with regards to how we construct our portfolios and give you some interesting examples of uncorrelated ideas we've got in the portfolio. So to start, just a bit of background and history about our business. We're a boutique fund manager that's been around for 22 years now. We currently manage over 10 billion rand of investor assets after having a great year in terms of performance, but also in terms of demand from new IFAs and clients joining our funds. We've had a consistent investment philosophy and process all the way from inception. We keep on refining and improving that process, but the foundation has been there for this entire time. Many of you will know the hedge fund industry in South Africa quite well, but for those that don't, in our industry, the Hedge News Africa Awards are effectively the equivalent of the Raging Bull Awards in the long-only industry, and we've got a very good track record of winning the long-term awards in that industry. They've had a 5-year performance award for 9 years, and we've won it for 6 out of the 9 years. And then for the last 2 years, they've had a 10-year performance award for the first time, and we won it for both of those years. On the top right of the slide is the 2 achievements that we are most proud of as a business. So our high growth fund became the first South African fund ever out of any category in the entire SA market history to deliver 10,000% returns for investors. Why is this significant? It means that if an investor invested 1 million rand in the year 2000 in our funds, they've got more than 100 million rand right now. Our mission as a business is to create wealth for our clients, not just deliver great returns, but to actually create wealth. And I think 100 times money since inception really epitomizes that mission. I'm very lucky and fortunate to have been part of that journey for the last 13 years, and it really is an incredible place to work. We've got an amazing team of people, and we challenge each other and make each other better every day. And I think that's what's been a key driver behind this return over that period of time. The second great achievement is in our pure hedge fund. For this fund, we've done 60 times money for investors since 1998. So R1 million up front is worth 60 million rand right now. But that fund takes substantially lower risk than most funds in the market and much lower risk than the high growth fund. So it's actually delivered 60 times return for investors without ever having a negative year. So also delivering a nice smooth ride for clients. Let's now look at how hedge funds compare with collective investment schemes. So firstly, over the last 5 years, hedge funds have fallen under the same regulatory framework as long-only funds. So we're both regulated collective investment schemes. We also run multi-asset portfolios. Both our high growth fund and pure hedge fund are equity weighted, but they also allow us to invest in fixed income investments offshore and other asset classes. Again, similar to the large categories like balanced funds and stable funds in South Africa. We also have various risk profiles catering for investors with low, medium or high risk appetites. Again, similar to the spectrum of collective investment schemes out there. What's different then is the fact that we have a bi-directional investment strategy. It means we can make money owning a share that goes up, but at the same time, we can bet against or short companies that we think will underperform the overall market or just go down in absolute terms. This is the crux of what defines a hedge fund and what makes it different from a long-only vehicle. This leads us on to the ability to then better protect investors in down markets. With a hedge fund and the additional tools at our disposal, we can make money in down markets, or at the very least protect our long book and our long portfolio from declines in the overall market. Let's look at some of the details of how our business was and what's changed now to improve access for investors. So firstly, we went from effectively hedge fund structures to regulated unit trusts, as I mentioned on the previous slide. We used to have a 1 million rand minimum investment enforced by regulation, and that's down to 25,000 rand now when investing directly, and no limit when you invest on a platform. Our funds historically were monthly dealing funds, but we decided about a year ago to launch daily dealing versions of our funds to make it comparable to the equivalent long-only products. We're also open to retail investors. There's no cutoff in terms of knowledge or asset size. And finally, the biggest improvement over the last year is the significantly improved access on the list platforms. We're now on all the major lists: Glacier, 91, Allen Gray, Momentum, also Hollard, Wealthport, and Ashburton. So it's really much easier to access our funds than a few years ago when one had to invest directly in a monthly dealing fund. Let's now spend some time on how we generate uncorrelated alpha. This slide tries to give you a breakdown of how we construct our long book, or the book of shares we own as part of the fund. So the large part of the fund, almost 2/3, let's say 60%, is what we call consistent compounders. Now, these are businesses we've identified that we think can grow earnings at a very consistent 15% plus rate for many years to come. They're typically very high quality franchises that has got very strong barriers to entry. It's very hard to compete them. They've got strong moats around them. So we think there's a high degree of certainty that they can achieve this growth for many years to come. A few examples would be businesses like Microsoft or Google, and historical examples of this was a business like Capitec in South Africa. This really gives you a nice underpin in the portfolio, where a large majority of the portfolio is growing at an attractive rate, is valued at an attractive multiple to earnings, and gives you a great underpin in terms of portfolio growth every year. The second category is what we call special situations or valuation mismatch opportunities. So our approach when analyzing a company is we value the company ourselves. So we determine what a share is worth. If the market price of that share is then significantly below that price, that's obviously the opportunity to own the company and to wait for that valuation mismatch to close and the share to approach fair value. So these don't only have to be companies that's growing at an attractive rate, they can also be more mature businesses, but where the price is materially different from where it's trading at in the market, or where our value is materially different from where it's trading at in the market. The other part of this bucket that I'll give as an example later on is special situations. And these are what we define as companies where there's material issues, where there might be a fraud or there's real short-term issues or a management change or something of that nature. Most investors, when they see something like that, will sell the position and run for the hills. They don't want that share in their portfolios. We actually see that as a trigger to go do more work on that company, to find out whether there's an interesting opportunity, and then to participate in that opportunity if we see it. These opportunities specifically are often much more correlated to the outcome of that specific company or the resolution of that specific issue rather than the overall market, giving you uncorrelated returns as part of the portfolio. And then the final bucket really delivers the potential for outsized returns in the fund. So we call this optionality, and we allocate about 10% of the portfolio to these type of opportunities. These are typically companies that are kind of offshore based, and often it's small companies challenging very, very big addressable markets. And these are the type of shares that can go up 5 or 10 times over a period of 5 years if they succeed in terms of winning that market. These are somewhat more risky than our compounders bucket because they're earlier stage and a lot of the growth still has to come, so they've got to still execute on the company's plan, but we deal with that by owning a more diversified portfolio of smaller positions in these companies. What this does then is it means that if only 3 or 4 out of these 10 ideas do spectacularly well, a few more do reasonably well, and if even 1 or 2 doesn't work out, this part of the portfolio will add substantially to your expected returns in the long run. By diversifying it, we also create further low correlation to markets because the payoff profile of these companies is largely dependent with regards to how they execute their business plans over the years. Let's now move on to a few examples and case studies of the types of opportunities in each of these buckets. So firstly, we're going to look at a valuation mismatch example in a share most of you will know very well, PSG. PSG is a South African holding company that owned historically a significant stake in Capitec for the past 20 years. That created huge value for shareholders, but also stakes in PSG Consult, Hero, and other smaller South African businesses. Over the last few years, a discount started opening up where PSG traded well below the value of its components. For the probably up to a few years ago, for the previous 18 years, PSG traded very close to some of the parts almost at all times. Due to the negative South African sentiment and potentially lower foreign interest in the country, this discount opened up. So PSG management took the fantastic action of deciding to unbundle the Capitec position and give it directly to shareholders. This effectively unlocked the discount and created huge value for PSG shareholders. This is then how the opportunity developed. As a result of the Capitec unbundling, you as an investor, rather than owning PSG, you got your Capitec shares and you got a PSG share with fewer assets left. So obviously on the day the unbundling happened, PSG fell substantially as the Capitec came out. Due to the reduced size, PSG also fell out of the top 40 index and out of the financials index. So this meant that there was 22 million shares that had to be sold by index funds on that one day where this unbundling happened. Now these are forced sellers. These index funds have to be out by the end of the day. The index is rebalanced, so they've got to sell. And we love buying from forced sellers. So we did a lot of work in preparation for this to be ready on the morning of the unbundling, knowing what our target prices are to acquire shares. We ended up being very active on the day. We bought almost 40% of the shares that were sold by these index funds at around 40 Rand a share. The day after, the share almost immediately recovered back to 45 Rand as the forced selling was over, and since then it's bounced back very nicely to close to 70 Rand a share. The beauty of this was that this didn't need the overall market to perform for the share to work. This was purely taking advantage of a special situation where index funds were forced sellers of shares on a day, and regardless of whether the market went up or down, we believe this would have been an attractive investment for our investors. Let's now look at a special situations example being Steinhoff. Now I bet most of you would ask, are we crazy doing a slide on Steinhoff? Almost all investors won't want to talk about this. In most cases, people lost money and they're very averse to the word Steinhoff. Well, I think in our case it's different, and I'm going to discuss why. We didn't own Steinhoff equities at the time that the fraud happened at the end of 2017. Obviously, the fraud was going on before that, but at the time it became known. We didn't own any shares. We didn't like the management team of the company. We weren't comfortable with how they account for profits and losses at the time. However, when frauds like these happen, most investors just by default run for the hills. They want to get this out of their portfolio. They want to move on. They want to talk to investors about other things. So that's often a fertile ground to at least hunt for opportunities to see if there's anything there. We went through the entire capital structure of Steinhoff. We looked at the equity, we looked at the debt, we looked at the prefs. We tried to see, is there any opportunities around this panic situation? So let me explain to you how we found the opportunity. On the picture there on the right of the slide, you'll see at the top there's Steinhoff. That's the listed entity, the equity that was listed on the JSE that most funds owned. This is a simplified group structure to make it easier to explain, but effectively there was two boxes here. They had the South African entity being Steinhoff Investment Holdings and the European entity being Steinhoff Finance Holdings. The South African entity had quality assets. They had acquired Pep and Ackermans, which is incredible South African retail franchises, thousands of stores, trading very well. The European assets were all the businesses they acquired, low quality businesses, and the key point here is all the external debt sat in the European entities. They borrowed there because European financing rates are lower, so they injected all the debt there. And also, the fraud and the misrepresentation of the accounts also sat in the European entity. So that was the one you want to avoid together with the equity. What the market missed was that the preference shares was issued out of the South African holding company. In the South African entity, there was no external debt, and you had high quality assets being Pep and Ackermans. And in debt, all that matters is the entity that's issued your instrument and that guarantees that instrument. So we identified this. We built a substantial position in the prefs after that fallen. They fell from 70, 80 Rand to about 20 Rand a share. We kept buying. We were probably the biggest buyer again over a period of many months, and it's ended up being a fantastic investment for our investors. They kept paying dividends or a yield to you of more than 20% per annum, and additionally, we got price appreciation of more than 50% when the instrument listed again in January. So we basically got all our capital back through the yield and a fantastic capital upside. And again, this return stream was not linked with the overall market. Let's now look at an example that many of you, or pretty much all of you, will be aware of, but I think it does a great job of covering the optionality element in some great businesses. So we own a substantial position in Tencent, like some other fund managers in SA, through our Naspers shareholding. If you look at Tencent 10 years ago, the business really started as a PC platform where there was messaging, and most of their money was actually made selling games to those same customers. So on the graph you see there, the big fat blue bar is Tencent's gaming revenue and how that's developed over the past 10 years. In its own right, it's been a fantastic growth story. But what I really want to cover on this slide is the optionality inherent in these tech businesses with large customer bases and the ability to then sell additional products to those customers to drive additional revenue and additional value for customers over time. So you'll see gaming is probably only about a third of total revenue now. The big red bar is social networking, which is WeChat, which Tencent has built over the past 10 years, and it's now the biggest messaging platform in China. The orange bar is then advertising that they've laid over their social platforms, their gaming platforms, and built a huge advertising business in China. And then you can see the yellow graph, or the yellow bar in this graph, is the fintech and cloud businesses. This wasn't even around 6-7 years ago. They built this from scratch, and effectively the cloud business is a Chinese business similar to Amazon Web Services, AWS, that many of you will know, and the fintech business is now, together with Alipay, the two biggest payments businesses in China that they've built through, and Tencent's built theirs through WeChat and through their other offerings. So this has been an incredible success story, and you can just see the benefit of these option-type payoffs, where this wasn't priced. 10 years ago, people bought this as a gaming business, and in the end, almost 2/3 of your value creation has come from these free options that people didn't realize Tencent could implement over that period of time. One last option that you had in Tencent that's worth discussing is, with their knowledge of China internet and the activity they see on WeChat, they've got great insight into what the future successful businesses will be in China, which businesses they can help build and support. So Tencent has a strategy of investing in these companies at an early stage and calling them associates or investee companies. They've created $350 billion of value through this portfolio of associates. These will be businesses like the food delivery app of China, Meituan, the Uber of China, many other gaming companies. It's been an absolutely fantastic success story. So that's not even captured in the revenue growth there, and it's added value on top of that. The final example is a business called Evolution Gaming, which I think falls both in the optionality bucket, but actually also in the compounders bucket. So Evolution is a supplier into the global online gambling sector. So most of you will know gambling at a casino, you play blackjack or you play slots, and that's been steadily drifting online. So people can now play games on their apps or their PCs. Initially, when this moved online, though, it was all just a digital experience. You had a little electronic slot machine or electronic board where your cards are dealt in blackjack. And it's obviously not nearly as engaging as sitting in a casino and talking with a dealer and getting your gambling fix there. So Evolution then revolutionized the space by introducing actual people to these games. So you've basically, any game you play that Evolution hosts, you've got a live dealer either dealing your poker hand or your blackjack hand. You can interact with them, you can ask them questions, you can type things, they can talk back to you, they can respond. So this has made the switch for gamblers from real world casinos to online significantly easier, and has driven massive growth in Evolution's client base. What we like about the business is the fact that you're not betting on one company to be the global leader in online gambling. They supply this IP and this software to all the significant companies in the space. So effectively, you're playing the growth of this whole sector without having to pick a winner. Obviously, a further benefit is the significant incremental profit margins that this business generates. Once you've set up a table, that table can take up to 5,000 people playing on it and interacting with that dealer, where in a casino, you can only have 8 people at a time. So obviously, this leads to significant scaling of your fixed cost base. And you can see on the graph on the right that EBITDA margins have expanded all the way from 35% to 65% over the last 5 years. We're very excited about this business. They grew earnings about 100% last year. We think they're probably going to grow in excess of 50% this year. So it's a great compounder, and there's optionality as the US gaming market grows, and also as they expand into Asia and other markets. All right, let's move on to our funds. This slide compares our funds with the largest SA unit trust categories that most of you will know. Our pure hedge fund has a very similar risk profile to the SA stable fund category, but over 15 years, at lower risk, it's outperformed by about 5% per annum. Our high growth fund has very similar risk profile to a typical South African balanced fund, while outperforming by about 10% per annum. And then a high growth can also be used as an equity fund replacement. It significantly outperformed equity funds over the long run, while taking lower levels of risk than SA equity funds. What we've done on this graph is compare our high growth fund since inception versus the entire South African unit trust industry. So we've said, had you on 1 Feb 2000 when high growth was launched, let's say you had perfect foresight and you could pick the very best unit trust in any unit trust category in the SA market and invest in that fund. How would that have compared to the high growth fund? Pleasingly, the outlook's good. As I discussed earlier, we're up to 10,500% return for high growth. The very best other SA fund has done 2,800% in that time. So we're about 4 times better than the very best fund in the market and about 10 times better than the overall JSE in that time. This fund takes a moderate to high level of risk and is appropriate for investors that are currently in a balanced fund or similar risk profile fund. Let's look at the annualized net returns over various time periods for the fund. The blue bar is the high growth fund, the grey bar is the JSE capped SWIX, and the red bar is the South African multi-asset high equity category. I guess the pleasing thing for us here is the consistent outperformance over various time periods. Over 1, 3, 5, 10, and 15 years, we've consistently outperformed both the market and the peer group funds by a substantial margin. If you look at the 3 and 5 year numbers, they are low double digits. We're reasonably happy with those given the tough market environment. But if you look at the 10 and 15 year numbers of kind of 18% or high teens kind of compound returns, that's really what we aim for this fund. And pleasingly, we delivered that over the last 1 year period for investors. If we move on to pure hedge and we do the same comparison, you'll see the pure hedge fund has done 6,300% return for investors, so 63 times money. It's again more than double the next best fund in SA over that time horizon. And additionally, in this case, pure hedge took substantially lower risk and low volatility to achieve that outcome for investors. We've only got a max 20% equity allocation in this fund, so it's got low sensitivity to the overall market. If we again do the exercise to look at various time periods, the blue bar here is pure hedge. You'll just see the incredible consistency of the fund delivering somewhere between 10 and 14% over every one of these 1, 3, 5, 10, and 15-year periods. A fairly consistent 5% outperformance versus the multi-asset low equity category, and a very healthy, say, 7% or so outperformance above inflation, while giving investors a smooth journey over that time. If we move on then to the benefits for investors of our funds, this, I think, is a key slide that shows what our funds bring to investors. What we've done here is we've taken the 5 largest SA equity unit trusts and compared their correlation with the overall market versus our 2 funds, high growth and pure hedge. And what you'll see is if you selected any of these 5 major funds, and some years you're going to outperform and some years you're going to underperform, but the one thing that's always in common is that all 5 of them are simply very highly correlated to the overall market. So even if you think you're diversified, you're actually to a large extent just adding more of the same risk and the same correlation to your portfolio. If you can see here, our funds are materially different. Over the last year, high growth, while comparable to a balanced fund, has only been 40% correlated to the overall market. So that's going to give you great returns at much lower correlation than other major funds. And then pure hedge is almost zero. It's only got 5% correlation with the overall market. So it's an inflation or cash beating income growth stream in pure hedge without adding any effective market risk to your funds over the past year. This is really what we want to achieve. We want to give something to investors that's differentiated from just more of the other products that's just going to pile on the same level of risk. And we think at least over the last year, this has played out exactly as we've designed it. If we just quickly spend this slide looking at the risk metrics of our funds to cover some of the things we've already spoken about. Downside protection is very important to us as a hedge fund. We know our job is to give investors both great returns, but also make the drawdown smoother for them. And I think our funds have done that over the past 20 years. As we've said earlier, PureEdge has never had a negative year, and the peak to trough drawdown, the highest drawdown it's ever had in this time, has only been 5%. It's had 88% positive months. High growth has had 18 positive years out of 20, with a peak drawdown of only 17%. Substantially better than the JSE, with a 40% peak drawdown in 2008, and again a similar kind of drawdown last year. So how does this play out in practice? I think last year was a great case study in risk management and a great year to use to compare fund managers and how they manage downside risk. What you'll see here in the month of March, that was the key month last year when the market was down about 17%, our high growth fund was only marginally down, and PureEdge actually ended up about 0.5%. For the first quarter as a whole, with the market down about 30%, high growth was down only 6%, and PureEdge actually ended up being up for the month, or for the quarter. I think this is exactly the kind of risk management result we want for investors. And then throughout the rest of the year, I think we did a reasonable job of capturing the upside of the market while having protected the downside materially in that first quarter, resulting at the end of the day to a JSE capped SWIX that was largely flat for the year, with high growth up 15% and PureEdge up about 12%. In summary, I hope this presentation has given you some insight into our investment process, how we build our portfolio, and the types of ideas we utilize to generate these uncorrelated return streams for clients. Outperformance without just being correlated to the overall market. Our entire team has worked very, very hard over the past year to make it easier for investors to access information about our funds and to also improve the accessibility of our funds, both for investors that prefer to go directly, but also on all the major platforms. Many of you have reached out and contacted us in the past year, and we're very thankful for that, and for those of you that's decided to invest. That's really what gets us excited and gets us excited to get up out of bed every morning. We want to come to work to generate alpha and return for our clients. So thank you so much for the support. For those of you that haven't yet spoken to us, please reach out. We're very happy to chat. Email us at info@peregrinecapital.co.za or go to our website and contact us. We're very happy to have one-on-one discussions where that would be productive. Thank you very much.